Hello, everybody. Happy Friday back from the Vegas week. And what a week it was. Very happy to be back here. How is everyone doing? We had actually hoped to do market minds from Vegas, and honestly, things were just hectic, crazy, busy, all good. Our students, everybody that attended, they were engaged the entire time, so we did not. But how is everybody? Did you miss it? Did you miss it? We actually had a lot of good commentary from people out there saying that they've learned some stuff from Market Minds, and just all good. All good. We will definitely be doing another one of these, and hopefully you'll be able to join us then. So here we are, Friday after the Fed, pre-holiday. Everybody's looking for Santa. Maybe Santa's already come. Who knows? Lots of interesting things going on in the market. We saw S&Ps down almost 100 points earlier. They've cut that. I'm looking up here. They've cut that pretty much in half right now. Two strangles for 13 grand. That is great. Snow X in the house. Jeremy, can't thank you enough, man, for your participation. Those of you that weren't out there or didn't live stream it, Snow X himself got up in front of people, was doing a little teaching. It was awesome. Kevin, thank you. I'm actually wearing this because in 25 minutes, I'm going on the Cow Guy. I have an interview with him on RFD TV in about 25 minutes. So I'm going to wear this so you guys can all tune in there. I agree. Snow X is the man. So out of Vegas, there were lots of questions on the wheel strategy here. Okay, what is the wheel strategy? How does it work? What's the risk? Here's so much about it. Can't lose. Well, yes, you can lose. Okay, what's up, Dorothy? I'm about to respond back to your email, but I am glad that you sent that to me, and at least you are on your way back home. It was great to see you too, Dorothy. Awesome. All right. What is the wheel strategy? I got all these silly icons, silly pictures today, I guess you could say. Okay. Let's talk about it. Okay. It is a very methodical approach to trading. Okay. With selling calls and puts. Okay. Not necessarily doing it as a strangle. Okay, because when we sell a call, sell a put at the same time, that's a strangle. Or we buy a call, buy a put at the same time, that's a strangle. This is selling on their own. Now, that may seem too risky, and it is not a type of strategy for everyone. Okay, let's just put that out there. It is not the type of strategy for everyone. Typically, though, it starts by looking at a stock that you want to own, maybe a stock that got hammered, maybe, and I'm going to go through a live kind of example here on Taiwan Semi, TSM, in just a few minutes, because that's a stock that traded down. We put a signal out there. We didn't get filled, but that's a stock that I would want to own at a certain price. So just as when we do our wish list strategy out here that does have a naked put to it, it is with the intent. Okay, it is with the intent that if you get assigned on your naked put, you are okay buying the stock. So it's got to be a stock that, you know what, you're looking to sell puts, collect premium, which is the idea behind it, but if you get assigned, you're okay with it. Okay, does that make sense? Okay, does that make sense? That's where this really starts from. And I would say that during like Liberation Day and some of the times over the last few years where we had significant sell-offs in the market, lots of options traders, maybe on the more experienced side, lots of option traders employed this strategy. Okay, so what's it like? What's it all about? When are the best times to do this? Okay, well, again, it typically starts with selling a put. Okay, if the put goes out worthless, great. You collect all your premium, you're done. Fine. However, if the stock goes below the put strike and you've still collected your premium, okay, and you get assigned on your stock, which again, it has to be ahead of time, a situation where you're okay with that, okay? So you get assigned on your put, and now what do you have? You have a long stock position, okay? At a much better price than just buying the stock outright because you sold a put, initially collected some premium. So then the next play, the next move in the wheel would be preferably on a rally in the stock, because obviously if you've got assigned and you have a long stock position, you'd like to see the stock go up. But what you would do then is sell a call, which at that point is actually a covered call. That's something we spoke a lot about in Vegas as well. In fact, I don't know, here, maybe I'm going to put you on the spot, Jeremy. Maybe SnowX would like to come on and do a live market minds on the covered call strategy. Okay. Cash covered short put means that you are okay. Your brokerage firm is going to allow you to trade that put because you just have enough money in your account. Meaning that, if that put was assigned to you and it turned into stock, you're okay with that. Heck yes is the answer. We're going to make that happen. Okay, so you've got this short put that turns into a long stock position. Stock rallies back, hopefully. Maybe it doesn't. But the goal then would be to sell a call up above to take advantage of collecting some premium against your long stock position. Okay, now what happens if the stock goes up? Great. That's going to help the stock position from your assigned put. And if it gets up to the point of the strike where you sold your call, you're going to have to make a decision when it gets there. If it doesn't get there, then great. You've had the stock move back a little bit. You sold a call, which is a covered call at that point, which you've collected premium on, and maybe it is worthless. And then you're still left with your stock position. Okay. And then let's say the stock continues to go higher and maybe your stock gets called away. Okay. Well, that offsets your position. Now, you can keep doing this back and forth just based on strike prices. But again, it really has to start with selling the put, being okay with owning that stock. We don't want to do it, or I shouldn't say don't. We don't, I would never do it, and most brokerage accounts would not allow you to start on the sell call side, because if you have a naked short call and you get assigned, now you have naked short stock position. Even though you could sell a put against that, that is not a covered position. You absolutely can do leaps with this. Absolutely can do leaps, which was another thing that Mr. SnowX talked about as well. Okay, so your profit potential, it's a little bit difficult to figure out your profit potential, but obviously the easy part of that is the premiums that you collect, both by selling a put initially and then maybe selling the call on the upside. Okay, but obviously it all depends also on if you were assigned, where are you getting that stock? Now, when does this work best? This works best typically when vol, I would say, is on the higher side. Okay, not extreme, not completely extreme, but on the higher side. And I say that because When we're selling options, when would we like to sell them? When vol is typically higher, right? So let's go through an example here. Let's go through. Now, I don't know that I would want to do it on earnings, David. And I think that's something that Jeremy actually talked about in Vegas is he doesn't do this during earnings. Okay. So how do we trade the wheel? How do we know which options to trade? Okay. Strike price, obviously, right? For puts, you got to predetermine whatever stock you're looking at. Okay. Where are you okay? Where are you comfortable with buying the stock if it were assigned to you? It could be right where the stock is right now. And if you sell an at the money put, you're going to collect a lot of premium. Maybe it's a little bit further out of the money. You collect less premium, but it gives you more room in case the stock goes down. Okay, so when we're looking at strike prices, certainly you can use expected move if you want to use those probabilities in your favor. But it really comes down more to you being comfortable with where you would buy stock. So you call up your broker or you're trading on your platform and you see TSM, which we're going to go into in a second, and say, hey, I would love to own 100 shares of TSM at $290. Okay. Now, you can use leap options, as someone just asked. You can use any options you want. You typically get more bang for your buck using shorter term options, usually a couple weeks, maybe 3-4 weeks, because that theta decay is going to be in your favor. Remember, options lose value, options decay. That time to expiration premium happens quickest as you get closest to expiration. Okay, so typically you want to keep it a little closer to the vest. Now, if you use a leap or an option 6 months out, 9 months out, whatever it is, sure, you're going to collect more premium. Absolutely. However, it also ties up your capital for a longer period of time. Before we move on here, had to put this one up on the screen. You don't have to type out "that's me." You can just type out "that's" or something. But this is a picture I got the other day of little Lou playing on the ground, looking into the mirror and recognizing herself. So I had to put this one up here. And someone I saw before, you guys are all putting your words up here. I saw someone say, how do you select your stock? You select your stock basically on where are you comfortable owning whatever stock it is. I don't care if it's PL from the other day or if it's Micron or AVGO from this morning, or we were looking at TSM or Oracle, whatever stock. Now, when you're selecting that, you obviously want to have that implied volatility a bit on the higher end, just so you can collect more premium. Sorry about this. Okay. All right, let's get back here. Break-even analysis and profitability, again, as I said before, it really matters, not just how much premium you're collecting, but where were you potentially assigned on your stock? Okay, so where's my drawing tool here? So you must take in account not just the premiums, but the overall performance of the stock while you've had the strategy on. Okay. So let's look at an example. Oh, sorry, Barry. Yeah, she was not traveling to Vegas. She was not traveling, but thank you also for being there. Mirror, mirror on the wall. I could have used mirror as the word of the day. That would be a good one. Okay, let's take a look at TSM, guys. Let's get TSM up on, and boy, we're not going to get filled, are we? We're not going to get filled. We're not going to take it. We're not going to get filled. Okay, so we put a signal out today. A broken wing call butterfly is what the signal I chose to use today. But to buy, basically to get into the trade right at this support area here of the 50-day moving average. So let's say you're looking at this chart and you love TSM, right? And you're saying, man, this is a great place to own some stock. Well, what could you have done? What could you have done rather than a signal that we put out? So let's say you are willing to buy the stock at 295. Okay. Well, maybe you could have just sold this put. Okay. Maybe you could have just sold that put. Does everybody see that? Does everybody see that? And sorry, guys, here, one of the workmen that are here. Sorry about that. Okay, so if you sell that put, let's say you sell that 295 put at $4.50. Okay. What is your effective price of owning the stock? Not 230. Not 230. If you are able to sell the 295 put for $4.50, what is your net? There you go. 290.50. Exactly. Does everybody understand why? So you would go into this trade looking at that and saying, boy, seems like a really good opportunity. I'd love to buy the stock here. Okay, I'm going to call my broker. I'm on my platform. I'm going to put in a bid at 295 to buy 100 shares of stock. Or you could sell this put, which then effectively lets you own stock at 290.50. So let's say you bought your stock at 295 and the stock is going down. You're like, oh no. Well, let's say it goes down to 291. You got a $4 loser on your stock. If this was expiration and the stock was 291, these puts are going to be worth zero and you're going to keep all that credit. Now, let's say the stock goes down to 285. Okay. You would have had a $10 loss on your stock. Here, you're getting the stock because you'd be assigned on your short put. You're getting the stock at 290.50. Okay, does everybody understand that? So again, it's all on the premise that you are willing to own the stock. Okay, let's play this out. Let's say you get assigned. Okay, so now you've got your stock at a value of 2 90, 50. Okay. Now, with the wheel, what you could do is as the stock hopefully starts to move better, even if it doesn't, maybe you then go in and look to the following week or 2 weeks further out and say, hey, I'm going to sell the 300 call. Okay, I'm going to sell the 300 call. So now what you have done is you have basically collected $12. You sold a call and you previously sold the put. You've collected $12 against your long stock position now. Okay, so what happens is you've already been assigned on that put, so you are left with a covered call. You have your long stock and a short call, and already have $12 in the bank. Does that make sense to everybody? Because this is what brings it back to trying to calculate your P&L. Your P&L is a combination of the premium you collect plus the performance on the stock. Okay, so if you're in this position now, long stock, and now just short this call, where would you love to see the stock go? Up until January, I put in January 2nd expiration. Where would you love to see the stock go? Anybody else beside Box and Camera Guy? Yeah, just short of the short strike or the short strike and buy that back, right? Because then what you have is the long stock position you have from a discount from selling the put initially now has worked its way up. You've made money on the stock. And then if you just get to the short strike or just short of the short call strike, now that call becomes worthless. Okay. So it's really just, and you can do this perpetually and just kind of do this back and forth, back and forth. But again, don't just go out there and do it and say, hey, this strategy is a moneymaker. Okay. It takes finesse, it takes expertise. It also takes, and I'm going to say it again, it also takes the understanding that you are putting this position on with the intent that if the stock goes down too far, if it blows through your short put strike, you are okay owning the stock. If you are not okay owning the stock by selling a put, then this strategy is not for you. Choose any stock you want. That's up to you. That is up to you. Well, Gloria, it could be 300. Sure, it could be 302. It could be 305. You're just going to get your long stock called away from you. You still will have made money on it. Because remember, it's not a naked call at that point. It is a covered call. Gloria, I sent you an email, by the way. Let me know if you received it. It's great meeting you. All right. Mike Clark, who all of you in Vegas now know who Mike Clark is, the guy behind the curtain. When I'm talking to someone during Market Minds, say, Mike, is this ready? Mike, help me out here. You guys got to meet Michael Clark. He was in Vegas. Mike, how we doing with the wheel here? And don't forget, everybody, in 4 minutes, I will be on RFD TV wearing this sweatshirt. There you go, RDB. Rinse, wash, and repeat. Okay, he tells me the wheel is 1 minute away. And guys, I know I have a short list of suggestions of things to talk about on Market Minds, but as we're doing today, I want this to be things that you want to hear. That's why we did the wheel today. All right, Mike Clark, I really need this wheel because I got to log into RFD TV. Your 1 minute is up. But I guess you get to keep looking at Lou, so that's okay. Don't know about any of where you guys live, but there's the wheel. Okay, I was going to say this Sunday's Bears game is supposed to be the coldest on record. All right, let's get the wheel spin here, guys. End of Vegas week wheel spin. Who do we have? Justin or Karen? Karen, are you in the house? Karen, are you in the house? Boom. Love it. All right, Karen. We're going to post up an email address on the screen here. Please send me an email with your mailing address and swag size and all that good stuff. We will get you out some swag. Everybody, thank you very much. Head on over to RFD TV. I will be on there in 2 minutes. Have a great weekend, everybody. Stay warm. I know it's supposed to be really, really cold in a lot of places. So have a great weekend, and we will see you on Monday.